the inflation is real and the inflation is enormous, and central banks will always deny it, but of course that's a direct effect of the money printing that has been going on since March 2020. And that money, it has been printed, that takes its toll on the markets, and it has to be played out to the bare end. We've seen the asset inflation. We'll now see the normal inflation, if you will, and it will hit people hard. Stock investors they're not the smartest investors. The bond investors, and especially the credit investors, I guess Greg Foss writes about this as well, but it's known in the markets that the more quantitatively oriented people, the big brains go to fixed income and credits, and not the stock market. So the stock market is lagging indicator, and it has gone up. I don't think it's very hard to predict that the stock market will have a rough year next year.
Hey everyone, thanks for watching this episode. If you enjoyed this episode, make sure you like and comment below. And to find future episodes in your feed and push notifications, make sure you subscribe. And if you click the little bell, you'll get every new episode as it's released. Thanks again for watching. In March 2019, an anonymous person by the pseudonym Plan B published a Medium article titled Modeling Bitcoin Value with Scarcity, which introduced his now infamous Bitcoin stock-to-flow model. Plan B also introduced his stock-to-flow cross-asset model, which includes gold, silver, diamonds, and real estate data. Plan B says he's a former institutional investor with 25 years of experience in financial markets, and he has a legal and quantitative finance background. The stock-to-flow models that he has created have been shared by millions of people globally and cited in most major financial publications and television shows. Plan B has risen to become one of the Bitcoin thought leaders over the last 2 years, and his model has predicted within a fairly accurate price range the rapidly rising price of Bitcoin. The models are not without criticism, though, with many popular Bitcoin thought leaders on both sides of the argument. Some have argued that Plan B's models are scientifically invalid, and one of his stock-to-flow models has recently broken with the recent Bitcoin bull run, since the price did not rise above 100,000 in 2021. In today's conversation, I sit down with Plan B and we cover why stock-to-flow model may have broke in 2021, if the stock-to-flow model is now invalid moving forward, what surprised Plan B the most last year in 2021, other than the stock-to-flow model, what else is Plan B looking at most, what worries Plan B about 2022 and beyond, and he also shares some of his early years, his Bitcoin origin story, and the Federal Reserve, interest rates, inflation, and more. So with that said, let's dive in with the one and only Plan B. Hey guys, I'm going to take a quick pause to introduce the first sponsor on the Jay Gould Show. I am happy and proud to say that this show is now sponsored by Withum Smith & Brown, which is a forward-thinking, technology-driven advisory and accounting firm that is committed to helping big and small companies be more profitable, efficient, and productive in today's complex business environment. Withum now also has a dedicated crypto and blockchain technology team to help early-stage businesses properly navigate all the crypto tax-related matters. I've been using Withum both personally and professionally for nearly a decade for all of my business's personal needs as well. I'm very happy with them and I highly recommend Withum. You can contact Withum by visiting their website at withum.com. Now back to the show. Plan B, welcome to the show.
Thanks, Jay. Thanks for having me.
First of all, I want to thank you very much publicly, just before we got on the call, for coming on the show. I'm a fan, and I appreciate what you spending your time with me today, and I'm fascinated with what you've been able to accomplish in the last couple of years.
Thank you.
Before I dive into your background and your Bitcoin origin story, as well as, of course, the stock-to-flow model, one of the criticisms from the stock-to-flow model is that it doesn't factor in demand. And I've been saying that the Fed's monetary policies, I think, have opened the door for the demand into Bitcoin or risk assets in general. Frankly, probably all risk assets, right? It's why we have this everything bubble that we see. So with interest rates so low and the hurdle rate is so low, basically the investors, I think, are forced into all these risk assets, which is propping up the valuations across all asset classes, obviously including Bitcoin. And one way, I had a friend of mine's an investor, one way to calculate that risk is something they call the equity risk premium. And for those that are unaware of what the equity risk premium is, just going to read, it says the equity risk premium is the excess return that investors in the stock market provides over the risk-free rate, right? Which is like the treasury or the tips, right? So this excess return compensates the investors for taking on relatively higher risk in an equity investment. And the size of the premium varies and depends on the level of risk in the particular portfolio, which you obviously manage money professionally. So I want to talk to you about this. Also changes over time as the markets fluctuate, right? But the equity risk premium is an excess return earned by the investor when they invest in markets over the risk-free return, right? So essentially, this is the one cause for demand into risk assets, in my opinion, relative to the hurdle rate. So traditionally speaking, this return compensates investors for taking on the higher risk of equity investing. Obviously, Bitcoin's not an equity, right? But I'm kind of equating it to that for a second here. Obviously, determining this is a little subjective, right? What the growth in the future, growth of any asset would be. But the one thing about your stock to flow model that I think gave Bitcoin investors some logical directional kind of sense for how Bitcoin might perform moving forward. But it also misses the one element, which I think this closes the logical loop, at least in my mind, which is the cause for the demand going into this. Like, I think the cause for it is there's nowhere to put your money. As Bitcoin Tina says, there is no alternative, right? So this leads me to the Federal Reserve. I had VJ Boypati on the show recently, and he actually agreed that the one real credible risk these days, I think, is probably in the short term, is the Federal Reserve with interest rates. So I've been telling people all the time, for the last year or so, I think that the Federal Reserve will be the catalyst for the Bitcoin bear market. I think we might be seeing that right now, with them tapering, the tapering and the acceleration of that. And now they're signaling they're going to raise the rates, and the market is starting to risk off a little bit, right? So what do you think? Because like guys like Preston, Greg Foss, Jeff Booth, all been on the show, talk to them, become friends with them, and they don't think that we can raise rates to a certain point. As Greg says, it's 11th grade math, right? So I think that they might be able to, but I'm just curious what you think, Blaine B. What do you think?
Yeah, well, both your points are very interesting about the equity risk premium and about the rising interest rates. I have been saying in the past that, and by the way, maybe for your listeners, I have been an institutional investor for the last 25 years, managing, well, in the beginning, bank balance sheets, then bigger balance sheets, and the last couple of years, a $100 billion balance sheet, dollar balance sheet, together with the team, of course. And that was very much focused on fixed income, so the interest rates and where they're going. So this really goes to my heart as well. It certainly is very interesting to see the 10-year U.S. Treasury rates moving up quite drastically over the last couple of days, actually, 2 weeks, from 1.5% to almost 180 basis points. So will that go on, or will that return? That is the question, and for sure we can have higher rates, right? I mean, in 2017-18, the rates was short of 3%. We could go back to those period, but what we have seen in all markets, not only the fixed income markets, is a quite drastic effect since COVID hit the markets in March 2020, which of course was followed by a lot of government measures that shut down parts of the economy, which had to be saved, kind of like after the financial crisis, where the banks had to be saved. So a lot of companies, think airliners, restaurants, cruise liners, cruising ships, etc., travel, everything travel related. So the Fed basically printed a lot of money. We have seen a lot of QE, quantitative easing, since March 2020. It went up like multiples of what we have seen after the global financial crisis. And as in a response to that money printing, the rates went down drastically. In the US, the 10-year rate dropped as low as 0.3, 0.4, I think.
Mm-hmm.
But in Europe, rates have gone negative 1%, and are still, I don't know where they are now, but still around zero, very low, lower than the US. What we have seen since the spike down of interest rates since March 2020 is a gradual creeping up of the interest rates till, well, 1.5
Mm-hmm.
is about the average it spent last year. And now all of a sudden it jumps up to 1.8, moving
And
to
by the way,
2%.
it started at like 0.9 last year and went
Yeah, yeah,
up pretty quickly in the beginning of the year. Yeah.
yeah. Same as this year.
Mhm.
So, but yeah, will it go on? I am of the group that thinks that the enormous amounts of money being injected in the system, the quantitative easing, trillions and trillions
Mhm.
over the last 2 years, make it almost impossible for the Fed to raise interest rates back to, say, 4 or 5 or even higher
Sure.
percentage. So
Yep.
that will not happen in my world.
Yep.
So and they're basically talking the rates up, as I see it. And if they talk hawkish, they of course don't have to act, because when they act, when they really put the rate up, all the loans, all the bonds that the Treasury uh, emitted, what they put out, the new bonds, they'll have to pay those higher interest rates, and that basically breaks the entire economy directly from the interest payments, and that's just a direct effect. The indirect effect, of course, is the valuation of every asset will go down, because it
Right.
for bonds, that's very mathematical. For
Mhm.
equities, you talk about the equity risk premium, but all the assets, even real estate, so all the asset inflation that we have seen last 2 years, and that we have talked about as Bitcoiners as well, because it impacted Bitcoin as well, but also real estate and the stock market, of course.
Which is most of the wealth for most people. Real
Yeah,
estate. Yeah.
yeah, so if they really end the QE uh, and going to raise interest rates sharply, then they'll bring down the stock markets. They'll bring down the
It
real
starts
estate
with the
market.
bonds, though, right? The
But it
debt would.
starts with the
Mhm.
bond market, because that's a very mathematical, direct relation.
And that's what Greg's basically speaking to because he's a bond trader as well. Yeah.
Yeah, yeah, yeah. So,
It's just math. It will break. Yeah.
yeah, but bonds are. I mean, for retail investors, bonds are like well, not very interesting, not very exotic. Of course, it's all in the pension funds. It's all fixed income. But for private investors like you and me, it's all stocks
Of
and
course.
equity.
But
And
like insurance companies and stuff, they use, well, they have historically used bonds, but moving forward, like Buffett even says this, like they're going to be forced, not him, but life insurance as an example, they're going to be forced into risk assets because they will not be sustainable if they have these 0% interest rates moving forward, right?
yeah, well, we were in that world in Europe for the last 2 years with negative interest rates, and as long as the interest rates goes down, that's okay, right? Because you'll have negative
It's when they
interest
go
rate.
the other way.
Yeah,
Yeah.
but your valuation, your total return goes up. And there was a really interesting thread from Jim Bianco Research today. I retweeted it about about total returns and how awful they were last week and even last year. Right, it was not a good time to be in bonds last year, because yeah, when interest rates rise, the bond prices go down, or actually it's the
Yep.
other way around, right? Because people sell. Um, the bonds, the price of the interest rate go up,
Sure.
and what we're seeing right now is that everything has been sold, right?
Mhm.
Bonds, stocks, Bitcoin, gold, everything. So there's
Yeah.
definitely something going on in the market, but we'll see. We'll see.
Well, this kind of leads me to the next thing. So you're in the same camp as myself. I'm in the same camp, by the way, too. I don't think they can either. But my old investor, I told you he managed like $12 billion professionally, like you do, with a group of folks, and he's kind of in this camp that he just thinks that they can raise the. But to your point, though, there is a breaking point mathematically, right? And maybe it's like 2 to 3%, somewhere in that range. There's no way we're getting back to 5%. Even he said that, but he was telling me it's all about this. This kind of this equity risk premium. I think he's thinking about it from the equity market perspective. But if the market really believes that the Fed is stuck, like we all do, then why does the market sell off? Why are we selling right now? in case maybe they don't believe it? Like, they don't have any conviction in that belief or something? Like, why are they selling just on the signaling from the Fed?
Well, let me first say I quit my job in March, right? So I'm a full 100% Bitcoin right now, and I'm a little
Nice.
less connected to the markets that I was a year ago. I don't have the Bloombergs running full time, but yeah, the reason why they sell, I don't know actually. It's of course the inflation that's spooking everybody, right? The inflation is, and the official numbers are always lower than the real numbers. We all know um, the the basket of products in the CPI is,
Mhm.
well, it's a chosen basket, maybe not representative for all of us. And like Michael Saylor likes to say, the asset inflation is of course a much better gauge of inflation, and my personal favorite gauge is the hourly wages, because there is um, a product price part of the inflation equation, but there's also a labor cost
Mhm.
part, an income part of on the inflation, and that's, I think, the most clear indicator. But it doesn't matter how you look, the inflation is real and the inflation is enormous, and central banks will always deny it. But of course, that's a direct effect of the money printing that has been going on um, since March 2020. And yeah, that money, it has been printed. That takes its toll on the markets, and it has to be played out to the bare end. We've seen the asset inflation. We'll now see the, well, normal inflation, if you will, and it will hit people hard. Uh,
Mhm.
and
And this
we're
is
not.
why the Fed's doing what they're doing to combat inflation, right?
Yeah, and that's also what investors see. And maybe stock investors are, how do I say that politely? They're not the smartest investors. The bond investors, and especially the credit investors. I guess Greg Foss uh, writes about this as well. But it's known in the markets that the more quantitatively oriented people, the big brains go to fixed income and credits, and not to stock
What is that?
market.
Like 3 times the size of the equity markets, the bond market, something
Yeah,
like that?
exactly. It's a bigger market. It's a daily volume. Also, it's much higher, and so the stock market is lagging indicator, and it has gone up, 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 up. So I guess
Yeah.
a lot of people. Yeah, I guess that's also an easy buck to make. I don't think it's very hard to predict that the stock market will have a rough year next year.
No, yeah. Well, this year we're here. But yes, it feels like still last year, by the way. I do that a bunch.
Yeah.
We're only like a few days in. Let me dive into the stock to flow analysis, or stock to flow model, I should say. For those that are not aware of the stock to flow model that you are super famous for, uh, it's the ratio of the circulating supply, aka the stock, to the number of coins being produced every year by the mining, aka the flow, right? So I heard that you said that when you read this Bitcoin standard that Saifedean mentioned it, and that kind of tipped you off initially. Was that your aha moment for looking into this and diving in a little bit further before you created the model?
Yeah, for sure. And Saifedean mentioned the stock to flow ratio, not the model, right? So he didn't
Right.
connect it to the market value.
Mhm.
That's my addition to it. And of course, stock to flow ratio. I knew that from the commodities market, so it was not the first time I heard it,
Yep. Of course.
because gold investors use it for comparing commodities like silver and platinum and gold, etc. So the stock to flow is quite interesting metric. Uh, and you know, my insight was, well, one step back. I missed a fundamental model in Bitcoin, and being an institutional investor, okay, the technical analysis is nice and certainly helpful, but um, you need to have a more fundamental model from first principles that, like the capital asset pricing model, and we'll talk about it in a minute, I guess, with the equity risk premium. Um, the capital asset pricing model says, okay, if an asset is more volatile, it should give you more return.
Yeah.
And you cannot have a high return without that volatility, because then, well, everybody would be a millionaire, right? So only the people that can stomach that volatility will will be able to earn the high return. And we as Bitcoiners are very much into that, right? Because the volatility is so high. But the stock to flow model missed this. I missed this fundamental model, and that's where I, of course, read a lot about Bitcoin, the white paper, and then Savining's book, a must read, of course, for every Bitcoiner. And the scarcity part of Bitcoin is what jumps out. That's what caught me and a lot of investors. There's only 21 million. They're scarce. They're even scarcer than gold, because even when the price goes up, normally when the price of a commodity goes up, the producers produce more of it, bringing the price down again. But with Bitcoin, you can't do that. So it's a very, very fundamental thing of Bitcoin that it has this built-in scarcity. The 21 million coins.
But like to what we saw before, there's no way to predict the demand though that causes these surges. What your model sort of does is it kind of implies that it's based off of the supply being limited over time, right?
I'll get to the demand, but first the supply. So my insight was the scarcer an asset, the higher the market value would be, because people value scarce assets higher than non-scarce assets. It's just everybody knows that. It's with watches, with art, with everything. So so that's when my addition was to take the scarcity stock to flow ratio and then map that to the market value of several assets. And even dynamically through time. That was the stock to flow model, and the stock to flow cross asset model then brought in the gold data and the silver data, real estate and diamonds. And then you see, like you would expect, that the scarcer the asset, so real estate is a scarcer asset, the higher its market value. And that's when I made this very rough. So it's a very rough model. It's a very simple model. It only has one input, and that is the scarcity stock to flow ratio. All the other factors, including demand, but all the other, and all the macro news in China and bans and whatever. So there's like 100 factors that also impact the price. Those are not in the model. So the model is very simple. It's very rough. I think it's very intuitive and very directionally right. But demand is not in there. But demand is a very interesting variable, because that's very hard to measure, right?
You can't predict that, really.
No.
And anything.
And Bitcoin is sort of a strange commodity asset. It's like a Veblen good, and in Veblen goods, the laws of demand and supply don't work as you would expect. So because normally, if a price goes up, if a price rises from of something, the supply of the demand goes down. And if the price goes down, the demand goes up. But with a Veblen good like Bitcoin or a Rolex watch or a piece of art, when the price goes up, demand goes up. It's the other way around. And that's because it's viewed as a luxury good, as a store of value. So supply, demand is a function of supply. It's derived from supply. So I think, and of course we could debate that, but I think that demand is a derivative of supply in the case of Bitcoin and other Veblen goods. But and that applies to other variables as well, because I got that question a lot. Why don't you have you considered the quantitative easing you do have to include money supply in the model, or all the macro news, the interest rates or China bans, and why are they not in the model? Well, I wish I could, but I haven't figured that out yet, and probably never will. So I guess it's already very astonishing that we seem to be able to predict the Bitcoin price as rough as we can as we can do it right now, but that we can do it at all.
I will say it seems that like my buddy Fred Krueger commented yesterday, and I put that post up last night, and he put a comment up, and he says, do you believe that the model is has partially become the cause of the decline recently? basically, are people front running the model? Because people do that, right?
Yeah, I think you
Like
give too
they're
much
trying to
credit.
front run the top of wherever you said, the 100,000. They're like, let me sell before everybody else tries. So I wonder if there's some of that happening. I mean, it's not only the only thing, obviously, to your point.
I've been, the model has been below far below the model prediction 3 times now since
Mhm.
I wrote it in March 2019. So this is the third time we're really below the model, but it was below the model value when I published the model. So we're basically at the same spot as 3 years ago. And we have been above the model like 2 or 3 times. And every time we're above the model, people say we're front running the model. Oh, everybody knows it now. We're front running, and this is super cycle, and blah blah blah.
Yeah.
And when we're below the model, so yeah, then everybody thinks the model is broken, and so I don't think the model has any impact on the price at all.
Okay.
And I can tell you a little story about the Black and Scholes model, which is the
Mhm.
option pricing model that
Mhm.
got Black and Scholes the Nobel Prize. It was published in 1973, and but nobody believed it because the one thing that made the model stand out was that you don't need a um, expected value of the underlying asset to price the option of that asset, because the option price is only dependent on volatility and some contract specific parameters, but like maturity, etc. But volatility drives the option prices, not the expectation. So the expectation, for example, of the S&P 500 has no influence on the options of the S&P 500 stocks. And that insight was remarkable, but um, not accepted right away. So it has been discussed until the beginning of the 80s, 81, 82, when people really saw and accepted this fact. But both gentlemen became billionaires, exploiting the model for almost 7 years, while all the information was out there. But there was a lot of debate, and yeah, I think that's the market takes time to digest ideas, and especially these more fundamental ideas.
So, in the recent interview that I saw with you and Pomp a month ago, I think you said that you didn't think that the model would hold up after, I think, 2 cycles from now. I'm not sure if it was the next cycle or the one after, but you were saying that at some point you thought it might break. And is that like based on the law of large numbers or something like that? Like, what is your reasoning for when you said that?
Yeah, well, first of all, it's just a model, right? And I can be wrong, so it could break tomorrow. And I really I can be wrong, so know that. But
Sure.
if we look, what I like about the stock to flow X model in particular is that we can interpolate. We don't have to extrapolate in time, like all the other time series models. For example, if you look at logarithmic time models, they show you this nice curve, but uh, you have to extrapolate into time. So we don't have data from the future, so that makes it a little bit less reliable. But with stock to flow, we have the two assets, gold and real estate, that have higher stock to flow ratios that are scarcer than Bitcoin at the moment, and we know the market values of those assets. So we know, so within the data range of the model, we can interpolate um, the the expected market value of Bitcoin when the stock to flow hits the same levels as gold and real estate. So I've been saying I can interpolate until the stock to flow of Bitcoin is about the same as the stock to flow of real estate, which is about 100 next cycle. So that's 2024, 2028. But after that, we're in terra incognita, and nobody knows what a stock to flow 200 asset will be priced at, because there is no stock to flow 200 asset right now. But okay, that gives us till 2028, which is long enough, I guess, to be useful, and very high valuations.
So you were just saying that the stock to flow model works because it kind of measures scarcity, like gold, right? And the more scarce something is, I guess, the more valuable those things are, right? To other investors. But then you also said previously that network effects also help explain the growth of this. Can you explain to the audience like what you mean by that when you say the network effects of Bitcoin? I mean, I think I know what I'm talking about, but would you just want to explain that one for the audience?
Yeah, to be honest, I think I never mentioned the network effects that explicitly, but I know Metcalfe's law, of course,
Sure. Yep.
which is for companies that experience exponential growth, like all the internet companies, Google and Amazon, etc., the FANG group. Um, yeah, and all, of course, the new inventions, technological inventions, experience this exponential growth. But and you can see that in Bitcoin, right? When you see the graph on a log scale, it still grows. It's
Mhm.
almost a straight line, and that's the signature of a exponentially growing asset. So yeah, it's there. But it's just an observation. So you
Mhm.
can just put a line on there and say, well, it's exponential growth. But then you run into that um, extrapolation problem. How far will it grow exponentially, and when does it
Mm.
stop? So you can make logistic adoption functions, etc., etc. But those are very dependent on their initial values and other assumptions. So yeah, of course, the big question is when does it stop, and how long will Bitcoin grow exponentially? And we have grown from below 1 cent to
Mhm.
40,000 right now. So it's amazing growth, and and it yeah and especially I mean for you as a tech investor as well. And I talk to a lot of tech investors. When you see it, it's almost like impossible what Bitcoin did last 10 years. It's well, it's there, something is going on there.
Yeah. Well, this kind of brings me to this like law of large numbers kind of discussion. I've had this discussion with a lot of friends on Clubhouse, that drop-in audio app. I go on there a bunch, and we talk about Bitcoin. And I'm friends with like American Hodl and stuff. And he comes on, and he's actually said that it's got network effects, but unlike the network effects that I was describing as to equating to, like you said, like Facebook or the fax machine, like anything that's had network effects, right? It just for those that don't know, network effect is the more things that, more nodes or participants that come into the network, the stronger the network is, and the more valuable it is for those that aren't there, as well as those that are there, and et cetera. And it's perpetual and it continues to grow, which is why Facebook's probably not going anywhere, or Meta, I should say. um, but everybody says that they'll make this kind of implied statement. They'll say, well, Bitcoin's the fastest growing asset, the best performing asset for the last 10 plus years, it growing at 200% CAGR. But nobody was buying it at a penny, to your point, right? So
Mm,
for most people, it's been 100 to 130% CAGR, realistically, right?
yeah.
For the last 7+ years or whatever. But using simple math on a compound interest calculator, like that's not even sustainable, because if you had 100% plus 130% over the next decade at 40% starting point, 40 to 42,000 starting point, I think that brings us to like $180 million a coin, which would be sucking up all the assets plus some, right? Like it's not even possible. So it's got to contract. That growth, that CAGR's got to contract. Where do you kind of see that shaking out moving forward, the compounded growth?
Yeah, well, that's coming back to the stock to flow X model and the real estate size of the market, about 100 trillion US dollars. Hence my name, by the way.
Mhm.
I think if that would be if we go beyond that then it will be one of the larger assets in the world,
Mhm.
and certainly run into strange valuation things. And in fact, what we're also seeing, I guess, is not only the assets growing exponentially in the case of Bitcoin, but also stocks and real estate at the moment, um, is that the denominator, so the currency, the US dollar, is affected as well. Because if all the money printing, the trillions and trillions of money printing, that seems to be having a direct effect on the valuations in that particular asset.
Mhm.
We have seen that, maybe from a world view. If you look at countries like Zimbabwe, Venezuela, Turkey right now,
Mhm.
all the countries that have run their currencies into the ground by printing it too much. And, and in Venezuela, there's these nice pictures now of all the currency, all the notes on the roads. Right, they throw them away. They're worth nothing. So
It's crazy.
what does it tell you? So in all those countries, the stock market went up exponentially before the currencies died. So we could also, and yeah, I'm always very careful to say it, but we could also witness the dying off of the dollar right now because of all the money printing. It obviously something broke, and I guess every institutional investor knows that the U.S. debt will never be paid back.
I mean, I think I read if you took all of the money of all the richest people in the country, all the millionaires, it doesn't even pay off the debt. So it's like, forget about taxing us. Just take all the money. It doesn't do anything.
The numbers are crazy. The trillions. I mean, trillion in itself is crazy, and so I guess measuring Bitcoin or any other asset in dollars, there will be a time when that doesn't make sense anymore.
That's right. That's the hyper-Bitcoinization argument, right?
Yeah, and that's what Preston and of course Saylor as well are talking about. Maybe you should measure things in Bitcoin instead of the dollar or gold. And that's why I make that stock to flow chart. I'd like to make that in gold instead of the dollar, because then you smooth out or you take out all the quantitative easing and dollar effects, all the macro effects, and that gives actually a very similar picture.
So I heard you refer to the Sharpe ratio when describing why Bitcoin was so attractive to you initially, right? You said, as an investor, you asked, what's the return? And in 2013, you can see this major asymmetric return profile for Bitcoin. You said the volatility scares less experienced investors. Like I tell you, I have a good friend, a very experienced investor. He's still scared.
Yeah.
But you also said that quant investors know how to deal with that volatility. Can you explain what the quant investors are doing to deal with the volatility?
Yes, it has to do with arbitrage, and it all connects together. So you were talking about the equity risk premium. Every asset has a risk premium, a return above the risk-free asset, which is basically the short duration U.S. Treasury. So there is a gold premium, there is a real estate premium, there is a Bitcoin premium, like the equity premium, and in fact, there is a very linear relationship between volatility, risk, measured as standard deviation or drawdown or whatever. There's a whole science in measuring risk, but let's take standard deviation from now. There is a linear relationship between risk and return on an asset. So if you take more risk, like with the equities, you get more return, hence the equity premium and the gold premium and the real estate and the Bitcoin premium. So with Bitcoin, it's and then in all the assets, the return is less than the volatility. So for with equities, for example, the return would be 10% on average per year. Mm-hmm. The volatility, however, would be the risk 20%. So more than the return. And that gives a Sharpe ratio. And I simplify it a little bit, but that gives a Sharpe ratio of 10% divided by 20 of about 0.5. But with Bitcoin, that's the other way around. And that's the only asset that has a positive Sharpe ratio. So with
greater
Bitcoin,
than 1?
Yeah, with Bitcoin, it's not 10%, it's 150%. Like, right? Or 100, approximately. It matters how, but let's say 150%.
Depends what frame you're looking at.
Yeah, and then the risk, the standard deviation yearly, or the maximum drawdown, or the implied volatility from the options, they all point to this about 80% risk. So that's 150 divided by, it's about 2. So a Sharpe ratio of 2 is
incredible.
That should not be there.
So as an sophisticated investor, and I'm talking to you, Mr. Investor friend of mine. So he's watching this, right? So he should have some risk on this asset. It seems incredible that and these guys don't, which blows my mind. I don't. You know what he actually said to me? He's like, if it drops below 30,000, I'm thinking about it.
Well, but here's the thing: the volatility. So it's all connected. The equity risk premium, the capital asset pricing model, the Black-Scholes option model that explicitly prices this volatility into option pricing. It's all connected, and where there's connected markets, there of course is arbitrage, and that's where the institutional investors come in. Although I have to say, I had the same talk with my old employer. showing them all the arbitrage opportunities, but they can, of course, not being under the central bank capital regimes, not in good faith exploit these arbitrages on a large scale. So I guess we're looking at family offices now and hedge funds doing this. I know a lot of them that do this, but and I'm doing it myself as well. So what you can do, you can see volatility as an asset on its own. Volatility is an asset, and the volatility of Bitcoin is 80%. It's the largest volatility you've ever seen. Let me give some context as well, because it seems like companies are not allowed to default anymore in the US and Europe, because they get saved, right? When the banks did something stupid, they were saved. They were not allowed to default. They were saved with, I shouldn't say taxpayers' money, but with inflation, basically, with printed money, with quantitative easing, which led to inflation. So everybody paid for the saving of the banks. Now, with COVID, the airliners like Boeing, the restaurants, the travel industry, everybody that got into lockdown is saved with more quantitative easing, so more inflation, which we are seeing popping up now. And that also that saving of companies that should have gone bust, that should have defaulted, that reduced the volatility. So volatility is not allowed to live in the markets, and it's very important for price discovery that it is allowed to live, that we have volatility and the pricing of assets accordingly. So when the Fed and the government deleted volatility from the markets, it didn't disappear, of course. It just went where it could live. And that was Bitcoin was one of those places. So we see extreme concentrated volatility in Bitcoin and other markets, by the way, and also return that is absolutely mathematically associated with the volatility. So to give you a very concrete example, you could do volatility harvesting, as we call it, in Bitcoin, where you buy the underlying asset, Bitcoin, and then write a call option on that asset. So it's a covered call option writing strategy. And then you would make about 35% of return. Of course, you have some downside as well, because if the asset goes down, that's on you. But you get a 35% on the call option, which is amazingly high, which is actually too good to be true. And the same is true, not with volatility, but in the futures market. At the moment, it's a little bit low, but the cash and carry strategy, where you buy the asset and then sell it 1 year later or 1 month later, but you get a premium. And right now that premium is very low. I think it's about 8%. But there was a time at the market peak when that premium was 30 or even 40%. And the option price were even higher than. But so you could easily buy the underlying asset Bitcoin. Don't care about what it is. Don't care about the direction, but just sell it right away at the same time 1 year later and make that 8 or 10, what is it now, percent, which is much, and with very low risk, I might say. Because there's some credit risk on the exchange where you do that, but you can those are guaranteed at the big exchanges. So that is a very juicy return.
Is this like FTX? Where do you perform that?
Oh, I guess the institutional investors would go to the CME with Fidelity custody, etc. But so you have the exchange where you can do that with institutional grade custody and exchanges and contracts. Even with the guarantee, I think.
Is this essentially like, because my buddy was asking me the other day, he's like, how do you hedge Bitcoin? Is this like the hedge? Is this how is that a hedge essentially?
Yeah. You can hedge. You can take out the risk of Bitcoin by selling it in the future, or by buying a put option, for example. Of course, you will give up some of the upside, some of the return. You'll pay dearly for that, especially the options, of course, are very expensive because of the high volatility. But what I think it is, Bitcoin is more like a hedge against fiat. So it's an arbitrage now.
That's what I said to him, actually, B. I said to him, if you don't mind me calling you B,
Sure, sure.
but but I said to him, I was like, he's like, what's the hedge for Bitcoin? And I wrote him back and I said, well, you're an institutional investor. What's your hedge on equities? And he gives me this list of thing in a text. And he goes, so what's the hedge on Bitcoin? I go, one more question. What's your hedge on the hedge? Because Bitcoin is the hedge. I think you're missing it.
Institutional investors that have to invest other people's money, bank savings, pension money, they can't take much risk because they have to have capital against all the risk.
Yeah.
So they can basically only do fixed income or very little equity. They are happy if they make 3 or 4% if they do credits per year. I mean, the 10-year treasury rate is 1.8 at the moment, so that's risk free, and you can take some credit risk on top of that if you're good at it. But maybe 3-4%. That's it. So a cash and carry strategy that basically has zero risk and then earns you 8 to 10%, and in good times 20 to 30%. It's like it's an arbitrage. It's a fiat Bitcoin arbitrage, and the same is true for the volatility. The volatility in itself is an asset, and you can go really exotic on that, right? If you're a quant, you'll do rebalancing strategies based on. So you're trying to actually replicate the options without using without buying options, so without the credit risk associated to exchanges. You just replicate the option and do rebalancing based on the volatility on the market. And so it's like quant heaven. This is really, and especially if you're in Europe and you can borrow at negative rates as an institutional investor. Yeah. And then put that into a, well, quote unquote, risk-free Bitcoin ARP.
Let me take a step back. I want to learn more about the origin story of the person behind Plan B, as much as you can share without doxing yourself, obviously. Can you share with me, like, I've heard some things. You're Dutchman, obviously, mid-40s and institutional investor, et cetera. But like, and you said, I think you have a economics degree and a law degree, which is very interesting. Bank financial markets, I think it was. And obviously you mentioned you and the team manage over $100 billion, et cetera. Give me the earlier version. Like, what were your parents like? What kind of socioeconomic conditions did you grow up in? Like, you don't have to dox yourself in any particular way, but just kind of, if you could broadly, like, trying to just give us an idea. How did you develop into who you are and see the world this way?
Yeah, that's a good question, actually. Well, my parents are very open-minded and sailors as well. So we're all sailors. So we like to go on a sailing boat and bring you and go where the wind brings you. And there's a very strong psychological dimension associated with sailing, and that's freedom. So I guess financial freedom is one of the things, and I mean, I never had it bad. There was always enough money, so that was never really the driver. But what really was the driver for me in my younger years at the university was the truth and arbitrages, like we talk about right now, things that were supposed to be impossible. So little puzzles, like efficient market hypothesis says you cannot make returns without risk. Well, maybe you can if you have inside information. Of course you can, but that's illegal. And maybe if you have a better algorithm that nobody has, that's sort of at the borderline, right? That's legal, but you have insights that nobody
Jim
has.
Simons.
Yeah. So the Black and Scholes example that I gave you, that was on my mind as a sort of mental picture when I was 20. So always been looking for advanced algorithms, markets, access to information, access to people with information, and joining the exotic and really complex parts of finance. So derivatives markets. I've worked on a trading room as well on foreign exchange stuff. But because my legal background also on structured finance, which is an entirely uh, different part of the field, but very interesting, where you create special purpose vehicles and securitize
Mhm.
cash flows, which has a lot of legal risk in it as well. The way you structure it, the way you exclude the risks and hedge your risks, indeed, is very, very interesting. So, yeah, I was always uh, very much inspired, but also helped by my parents to do these little discoveries and later bigger discoveries, and went on these treasure hunts, from astronomy to computer science to, well, investing, if you will, which is, and investing, of course, is the. I always saw that, and still see it as the one area where you can transfer knowledge into money, into directly, without any. I mean, if you know, you know. If there is an arbitrage, you can everybody can do it. You don't have to be an institutional investor. And if you're right, you win. If you're wrong, you lose. It's like a football
Yeah.
match. Very clean, very efficient, and very challenging also, because it should not be possible.
Yeah, it's funny. So you know who Naval Ravikant is? Do you know who
Yes,
Naval
yeah,
is? Yeah.
oh, sure.
So he as a kid he said his mom worked and he would have to come home from school and go to the library and she encouraged. It always comes back to your parents. I swear to God. Like I do these interviews and I always try to get to the essence of like what motivated you early on and what continues to motivate you. People like Scaramucci and myself come from blue collar families, so not that we struggled with money. It was very kind of um, middle America,
Hmm.
probably what you probably had too,
Yeah,
based on
yeah,
what
yeah.
you're saying. So we weren't like, I wasn't desolate and poor, but I wanted more. But then you have more. What continues to motivate you? And then I had Bram Cohen on, the founder of BitTorrent, and he's like a beautiful mind, like he was playing with a puzzle the whole time I was talking to him. I didn't know it. I was hearing click, 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 and he's just sitting there looking at me and he's talking. And I asked him about the puzzles. I didn't know he was doing that. I thought maybe somebody in the background was doing something. I couldn't tell. And then he goes, "Oh yeah, I got a puzzle right here."
Yeah.
Because in his mind, it's like everything is just a game, right? And he's trying to solve. And that's what I noticed with Naval as well, and a lot of other interesting folks like yourself. It's like you're trying to solve something. It's not really about the money as the end goal. The money, it's like a game.
It's exactly that. It's the intellectual part of the money. The money tells you if you're on the wrong, or the wrong, or the good road, and yeah, especially, and it's the curiosity that drives everything. And
Intellectual curiosity.
I guess as a parent, that's a very important thing to stimulate. When your child is interested in the stars, then by all means buy him a book
Yes.
for Christmas or something about the stars, and encourage that curiosity, because that drives everything.
So I heard your Bitcoin. Everybody's heard your Bitcoin origin story that knows who Plan B is. So we don't need to rehash that. But I heard you say that in 2013, you first heard about it. And like everybody else, you kind of missed. You thought you missed it.
Yeah,
And then in 2014, it crashed to 100. You said you thought it was dead. Then it went to 200, went to 300, and then you went in. Right? You were like, wait a second, no.
yeah,
Um, as I said, you have some friends that are professional, kind of institutional investors, and I think I said it earlier. One of my investors, my previous company, I don't have investors anymore, but my previous company, he said, if it drops to the low 20s, I think I'm back in. Scaramucci even had, the Winklevoss twins on stage at the SALT conferences in 2014, and he didn't listen to them. He was dismissive, and but just got in last year, as we all obviously know now. He made a big splash, right?
yeah.
Um, why do these professional investors like yourself, Mooch, others, why do they try to time the markets on the best performing asset that we've ever seen? Like, what is the time? Why not just DCA into it, knowing that it's got this volatility, and I'll get some low and I'll get some high, and if it drops, I'll buy a little more as I go. Why are they trying to put a lump sum all in at once when they tell people as investors you shouldn't do that? Yet they do that.
Yeah, I don't know. I didn't do. I sort of DCA'd in, but over a year, 2 year, 3 year
Okay.
period, maybe. But and I guess most people do that. They um, um, put in a small amount to test it, and then when it doubles, then well, I should have done more. And then, okay, I'll
Depending
do
on which
some
part of
more.
the cycle you got in.
Yeah, and that doubles, and then well, holy, and then the big load comes. But um, yeah, I guess it's a risk thing, and stepping up your investment. I think all institutional or professional investors do that. They don't go all in at once, and have to get used to the asset. which is it's a very complex thing. It's something, and we talked about that with the Sharpe ratio and the volatility, something we have never seen before. So it also reminds you of Ponzi schemes and bubbles, and the less curious and the less intelligent, maybe they get stuck at that point of view, and they think it's a bubble and a Ponzi. But once you take it, it takes effort as well. You have to read and make yourself read through the Satoshi paper, the Bitcoin white paper. It's not an easy read. For me, well,
No.
if you're into math, if you're into that thing, it's easy, and into computer science. But if you're just an investor, that's a hard read, and you don't get it. I mean, even if you're into that stuff, the rabbit hole, as we call it, goes deeper and deeper every time you read the white paper. Every time you talk to people like Brian Cohen from the BitTorrent, or Adam Beck.
Yep.
Every time he tweets something, every time of course, Adam Beck was mentioned, right, like referenced in the white paper. So he's especially interesting person to listen to. Every time he says something or shows something, it opens another rabbit hole, and you fall into that.
Got to start researching that now.
Yeah. So it's and also for me, right? I'm just starting. That's the feeling. I'm just learning, and that's why I quit my job in March. Like I want to go all in. I want to go not money wise. Well, with the rising, it almost gets to the point. But I mean, from a intellectual point of view, I want to know all.
That raises a question. So you just made a comment, like
Sure.
From a net worth perspective, when you first started going in DCing over the first couple of years, like how did you decide percentage wise of net worth? I'm going to put this much in over some period of time. Like how did you? And obviously, the old saying is like with Bitcoin, if you did like 1 or 2 or 3 to 5%. In 10 years, it's going to be over 100% of your 99 point something percent of your portfolio, probably based off of the expected returns. How did you do it?
Yeah, I didn't go all in. That's what I'm taught, and what I have seen. Of course, you never put all your eggs in one basket. So you have your house or real estate. You don't sell that to buy Bitcoin. What I did do was sell my gold. So I saw gold and Bitcoin as commodities or sort of competitors. Gold obviously doing nothing for year after year after year. I think the risk return on Bitcoin were just better. So I was an old gold bug, actually. That probably helped me understanding the ideas behind Bitcoin, especially a stock to flow kind of scarcity
digital
ideas.
Gold, right?
Yeah. And converted that into Bitcoin. So that was my rotation out of gold into the new gold, if you will. But not all. But then it grows and grows, and of course, the decision is not easy to rebalance into your original position or let it just run.
Letting it run's the hard part for really astute investors, because they want to rebalance. Look at Kramer on television earlier last year, right? He was saying, "I'm selling my position. It's gone up too much." It's like that signals negative to the market, obviously, for people who listen to him, because then they start doing it too.
But for an institutional or professional investor who has done that all his life, that's the prudent thing to do.
Yeah,
to take some profit and then look for the other asset that has a higher estimated value. Yeah, but there's nothing else.
Good luck.
There is nothing else. Show me one asset with a Sharpe ratio above 1. There is nothing else. So, well, we could talk about Bitcoin versus crypto, because there's a lot of coins, of course, that have done better, like Ethereum, etc. But it's smaller. It's.
Do you mess around with the altcoin market, because you obviously understand charts and TA and all this kind of stuff?
No, I don't do it myself, but I can understand that investors just see it as a number on the screen. It doesn't matter.
It's not about 20 years from now, right?
Yeah. And so, but for me, the Ethereum or the clones of Bitcoin, like Bitcoin Cash or Bitcoin SV, they're totally unattractive, because they don't have the things that make Bitcoin great for me. The decentralized part, that you don't need a server, but have all this peer-to-peer, the BitTorrent part. the scarcity part, the not being a company.
Let's go to that. Actually, that's one of my questions later. I want to go to that. So can
Sure.
you share to the audience, what do you believe people should be most focused on to gain their conviction in Bitcoin? They shouldn't just follow the model, right? They should gain conviction. I always tell people, I point them to Saifedean's book, but also VJ's book, I think, is great. The Bullish Case for Bitcoin, or his article. This is even easier, the Medium article. Which properties do you find, the most, I guess, interesting, or like we talked about network effects, or to tell people what you think they should be most focused on to try to build their conviction in Bitcoin?
Yeah, the first thing you should read is the Bitcoin white paper, and if you don't understand it, learn it.
Mhm.
There's a lot of people who can explain it. Search for it. You have to know what's written in the white paper. You have to understand the three technologies behind Bitcoin and why it's really breakthrough technology invention. What's what Satoshi did there? Uh, what why there is proof of work? Why we use mining and what the hash the SHA-256, how that all connects. You have to know every line in the Bitcoin white paper. And if you don't understand a thing, look it up, learn it, because it's essential. The white paper is only 9 pages,
Mhm.
including the references, and it's so well written, so clear, so simple actually, that it's like a poem. And that's the absolute first point. Then I would say the bullish case for Bitcoin from VJ is second, because it's easy to read and
Yeah, it's easy.
easier than Safety's book.
Mhm.
Then you get a connection with with money, with the financial market. And then I would say you're ready for Safety's book, The Bitcoin Standard. Those three are absolutely must read.
Mhm.
And then it's all learning by doing, I guess. Just allocate a small amount. Don't wait for the like you said. Don't wait
Yeah.
till it comes down. Don't wait. Just put in a small amount to learn. And for one person, that's $1,000. For another, it's 1,000,000. But put in an amount that you can lose, that you're willing to lose.
Would you say that it maybe 1% less, or what do you think that is for people
Yeah, everybody has to decide that for himself.
on
But
their own?
your first investment.
Well, you're not gonna miss the 1% of your net worth. It's like
Yeah,
whatever, right?
less. No, but I would say 1% or less. Maybe
Mhm.
just see how it works.
'Cause you'll
Um,
pay attention then. Yeah.
yeah, and get a what exactly. You learn faster when you're doing it. So maybe get $100 on the,
Sure.
not even as an investment, but to pay coffee,
Mhm.
to lose, to buy stuff, and learn how wallets work, and learn how to an exchange works.
By the way, I messed around with NFTs earlier this year, or last year, I should say. I keep doing it, just for that reason. I wasn't
Sure.
necessarily interested in NFTs, but I wanted to understand what everybody's talking about. And then from that, you start to really mess around with like the tech and that, and the wallets and all this kind of crap, which I really didn't do. I was a Bitcoin buyer and holder. I was a hodler. That's it. So when I was messing around with that, I was like, oh, totally understand this now.
Yeah, yeah,
This
yeah.
could be an entryway into people into Bitcoin. Actually, in some ways, I'm not advocating it. I'm just saying I can see how they'll lose their shirt and then at least know how to use wallets, for the most part.
Yeah, and I know a lot of people who got rich with that as
Sure.
well, because
I
it's
know some people have made a lot of money from
yeah,
NFTs,
more than
but
Bitcoin.
that's
So
a skill set that I don't necessarily have, but yeah.
no, same here, same here. So, but yeah, learn by doing, and Twitter. Twitter is I was not on Twitter before Bitcoin.
Yeah.
Um, I think I opened the account in 2017, mainly at the end of 2017, mainly to express my opinion against that fork. That was the fork war.
Mm.
The
Mhm.
first, well, it was a very large attack of on Bitcoin, and if that would have succeeded, Bitcoin would be gone by now. But it didn't, and there was especially Roger Ver played a very bad role at that time. And
Mm.
I basically opened the account to troll him. I guess that's what we would say at the moment. But it was so unbelievable to me that people actually bought that story of him, and the whole big block story. Read why can't you see that is a bad thing, and that will centralize everything, and the arguments are fake and blah blah blah. But anyway, that sort and then I just lurked for a couple of years and listened to the people like Adam, and I don't know if Preston was already there, but VJ for sure, and the Winklevoss brothers, etc., etc. And oh, by the way, Andreas Antonopoulos. That was one of my big teachers as well. He has very nice videos, so that's, I guess, must.
I met him on Clubhouse, and he was telling people how you should use your Bitcoin to pay people. So I was like, whoa, wait a second. What are we talking about? But he has a different perspective around Bitcoin. It's
he went the other way a little bit, but his early work is phenomenal.
Yeah,
I've
read.
And he has an introduction. I think it's 5 years old, but it's beautiful. And but from there, and then I got the idea for the stock to flow to make some kind of model, and I, the whole scarcity 21 million, the halving has of course a role in that. So I started tweeting in end of 2018, I guess, working up to the article in March 2019. But that, I think Twitter is beautiful because you can follow the people that you select. You can follow the interesting people and leave.
So some people were commenting yesterday, he blocked me or something, but you can also block people if it's annoying you. Like, why do I want to see it?
Exactly.
I don't understand why people get so bent out of shape on getting blocked on Twitter.
Yeah.
Why do I want to see you saying negative things? You can say whatever you want. I can't stop you, but like, I don't want to necessarily see that. I don't know.
It's just for me. It's just noise control, right? In the beginning, especially with 1 million followers, then everything comes 100 times as big. I can't read all the comments on my own tweets, and I want to read them because that's why I'm on Twitter. So every bullshit comment that just somebody said, "Oh, your model is bullshit," or when Plan C, or those kind of
when Plan C is a funny
the first 100 times I heard that, I laughed about it, but after 1,000 times, then I just block. And for me, it's just noise control. So I have about 60,000 people blocked, which I guess is pretty. Well, it's also a lot of shitcoin sellers, of course.
Yeah, of course. You probably get DM'd all the time. Will you promote my shitcoin? They don't say that, but
I close my DMs for that reason. Because
that's right. Yeah, you did. That's right. Right. I think you followed me just so I could DM you or something, right? That's because of the Preston intro.
Yeah. I can DM you, and then you can DM me. Yeah. But there's of course a lot of impersonators and scammers, people that copy my entire account but have like 0 followers or 10, and every new follower of mine gets gets at least 3 scammers DMing him. Hey, I'm Plan B. How's your trading? And they're going to be ripped off. And every comment under my tweet, there is a scammer. There's an impersonator with my icon, and a lot of the new folks
looks just like you. And the names are all, somebody used mine. I did JAYGO capital I.
Yes.
Instead of the L, it's capital I, and I was like, wow, that one's good. How did they do that? And then I like copied it, put it into like Word, and I was like, oh, it's an I. Okay. I couldn't figure out how they did it. I was like, that's crazy.
But I hate that of Twitter. And it must be a pain in the ass for Twitter as well, but it makes the platform almost unusable. And but yeah, I'm very.
Did they make you a verified account?
No, they can't, because I'm
you're not human, right? Well, anonymous, rather. You are human, but
also. yeah. But no, the blocking and the trolls are terrible. So it's like, I had some criticism, and then he blocked me. No, I don't block criticism. I block dickheads. I block jerks. The rude people that just say, well, your model broke, but then don't give a reason, don't give a source, don't give an analysis. And that's part of Twitter, and that's part of Bitcoin, the toxicity, and that's all good, but don't expect me to waste my time on that.
So I just want to go back to one more thing on the timing of markets and this kind of stuff, because actually you said on Palm's podcast, I got to ask you, you said that you might try to time this market at the top. You said that you won't tell anybody, but you might signal to the market or give a hint or something. I forget what your hint was. What was that hint? I forget now. So you said you might say something or do less something, or I don't know, when you think that the markets are topping.
Yeah, well, yeah, that refers to your very first question. That is the model front run, or do people sell when the model becomes negative and says there will be a bear market, for example? And in the funny thing is, the growth on the account was so fast that I still see it as my personal account, not knowing there's 1.7 million followers. So I like this and I like that, and I retweet a little bit, and then everybody is following that, and it's not like a homogeneous group of investors and quants anymore. It's like everybody. Yeah, and that's not always a good thing. So there's some people that just follow everything I say, for example, like it's the truth, and yeah, I trust you. Don't trust me. Do your own verify it. Do your own research. I just here for ideas, and I give ideas. And I don't charge money. I don't have ads. I make zero money of the Twitter account. So in Palm's podcast, we talked about the on-chain signal. So I do a lot of on-chain analysis, and I have a small group of quants that do that with. It's very, very fun, very much fun. And it's very new.
This is like the Willy
Woo, Clemente,
Clemente.
Yeah. But Willy and Clemente use the Glassnode data. I do that myself. So I have a node. I crunch the 400 gigs of data and make my own signals. So it's a little. So we have a full stack of creating signals and then backtesting those, and then evaluate the investment before, make trading rules and investment. Evaluate investment, and that's all done automatically. So it's searching for strategies, the algorithms, and then so we were talking about the on-chain. One on-chain signal of me, and I stopped twittering about it because that signal identifies FOMO transactions at the top. So every time there's a top, it flashes red because there are certain kinds of transactions. And think about, well, it could be transactions with a lot of inputs and a lot of outputs, or from certain addresses, or young addresses, or big, well, something like that, right? It's a combination that's proprietary, by the way, so I haven't published that. But when that signal flashes red, I will be very worried, and it didn't flash red yet. So that's why I believe that's one of the reasons I believe.
Is it yellow?
yeah. I think last time I tweeted it was about yellow. Yeah. It was not blue either. So somewhere in the middle, which leads me to believe, together with stock to flow model, of course, we're at the lower bands of the standard deviation, that the peak is not in yet. And but I sort of thought, like, well, when it flashes red, when the peak is in, I will sell some Bitcoin, not all of it, because I couldn't risk the super cycle going on and me not in there, but just a little bit to finance and fund the bear market that will probably come after that. But I was thinking, with a account that I have at the moment, if I tweet that just like any other tweet on a personal account, maybe some folks go berserk and go into full panic mode, and the market. I don't want to crash the market. I don't.
No.
So I thought it was better to not.
Yeah, you almost have like a responsibility at this point because of the amount of influence that the account has. So you can move markets, right?
Yeah. Yes and no.
You're not going to move it longer term, but in the short term, people would. Like you said, there's millions of people that follow. Some of them are going to start selling based off of that information potentially. True. And then it creates a movement, and then it reverts. Obviously,
true. But maybe that's funny. But I don't feel that responsibility. I think it's I think from principally it should be everybody's own responsibility. I just push out information and do with it what you want. But I guess I have to be a little bit. Aware of that. And,
I tweeted out the other day. I said $69,000 was the Bitcoin top, but it will also be the Bitcoin bottom. So 69,000 was the Bitcoin top. It'd also be the pun intended, by the way.
Very 69. True. Yeah. Very
so you're saying it probably isn't the top based on what your indicators are and what you're looking at. Yeah. And where do you think the bottom might be in this? Because I think it's probably what we saw last year. If it doesn't go much further, it seems like 30,000 is a pretty strong support level at this point. What do you think could be a bottom for this cycle?
It's very. It has nothing to do again with the stock to flow model, of course. No. Just my personal opinion.
It's more like TA almost. Yeah,
almost TA. And of course, I did try to do that with the floor model, which epically failed in November and December. So I throw that away. One thing I look at for bottoms is 200. Week moving averages, and I think that's at around 19,000 at the moment. So Bitcoin has never gone a monthly close, has never had a monthly close below the 200-week moving average. So that can be seen as a bottom. But
That's
even
interesting. So my buddy might be onto something with his 20 number. That's
yeah. But it's very, very low, right? So
That's like a short moment and it's going to bounce. Yeah,
exactly. That would be a perfect moment to buy.
Mhm.
But then there's the realized cap, the realized price. From you can do a 200-week moving average or another a time interval, but then not equally weighted, but weighted with um, how much bitcoins were bought in that month or period, and then weight that against the price. So you can weigh the price based on how much bitcoins were traded at that price,
Mhm.
and then you get a realized cap, a realized price, and that is much higher than the 200-week moving average, and so that's a much.
What is that currently?
It is 24,000, I guess.
Okay.
And depends how you 24,000 based on the price of every Bitcoin, every single Bitcoin of the 18.9 Bitcoins out there when they last transacted. That's
Okay.
24,000. Um, so yeah, but if you make that into that number is heavily skewed by the lost Bitcoins and the Satoshi, the first million Satoshi coins. So if you narrow the window down to say also 200 weeks or less, that number goes up significantly to in the 30,000-40,000 range, depending on
Mhm.
window. So that's, I can really not see it going below 30,000.
Yeah, that's kind of what I think, but at a high level, I'm not doing the analysis like you are, but it seems like there's a strong support there, based off of where you just look at the chart and where it kind of like kept bouncing earlier in the year.
Yeah, and there's one other thing. It never went down below the last all-time high. So the last all-time high, of course, 2017 was 20,000.
Mhm.
So it shouldn't go. It never happened.
Yeah, exactly. So when you look at those charts, you draw that line across. The same thing I did last year in 2020 in March when VTI and SPY kind of bounced to the bottom. You could see the speed and the velocity of which it went down, and it started to slow, and then it came back, and it was right around the time that the Fed, I think it might have been the day, the Fed announced basically an unlimited checkbook, right?
Yeah,
But when you looked at that and you snapped it back, it went back to 2015 prices in the equity market, and I'm like, that's a 5-year regression back. Like, can it go lower? Of course it can, but like it seemed like that was a pretty, and then I also looked at from equities perspective, it's totally different than Bitcoin. What was the dividend on the S&P? Which it was going up as the price goes down, right? So obviously if earnings change, that would not be the case, but that's another thing to kind of look at. I've looked at it in the S&P. You can't do that with Bitcoin, obviously, but like what's
yeah,
the return profile for the dividends? And at some point it makes sense for investors to just say, oh, well, that's not so bad.
yeah, exactly. And if we look at last year of Bitcoin, it spends all the time between 40,000 and 60,000, around
Mhm.
50,000, if you will.
Yeah.
And so the average price of all the Bitcoins that are transacted, of all the investors when they get in, is getting higher and
New
higher
money.
towards that 40 to 60K range.
Mm.
And
Creates a new floor. Yeah.
yeah, it creates a new floor, especially.
Yeah.
Yeah.
So look, year in review, 2021. What surprised you the most? And what do you think the biggest catalyst? There was a bunch, but what was the biggest catalyst for us not getting to 100,000 plus? Like, what do you think happened last year?
Yeah, I guess the main event was China ban of
Mhm.
mining. Uh, yeah, scared all the miners out of China. China has always been a very had a dominant position in Bitcoin because of the mining, because half of the Bitcoin mining was there. It was always perceived as a risk, as a threat.
Yeah,
So now they banned it.
51% attack. Yeah.
Yeah, so the actual threat and fear became reality. And yes, the hash rate went down 50%, and then it went up to it started to move up 2 months later uh, to the new all-time high right now. And all the miners had moved their coins or their miners to Kazakhstan and
Mhm.
the neighbor
They're having
countries
issues
of
right now
China.
too, actually, right? With the power
Yeah,
outages. Yeah.
yeah, big issues, big issues. But most of the miners also went to the United States, of course, Texas and flare gas and etc. Because Kazakhstan, the turbulence we see there right now is not impacting the hash rate too much. So, but that was a big thing, and together with it, the price went down because all the miners, of course, gone and the hash rate gone, created a risk. Will it come back? Will China take over the hardware and 51% attack the network or something? And the miners, of course, had to relocate the hardware, and that cost money, so they had to sell all the bitcoins they had, or some had to do that. Large selling, and so that was a major surprise because that came for me at a bad moment, because that was that was exactly the moment that Bitcoin was rising and rising to the stock to flow levels of 100,000, and then all of a sudden, bang, we're back at where are we now? Well, 40 something, and yeah, so that was the biggest surprise to me. But yeah, absolutely.
Do you believe in the Bitcoin lengthening cycle theory?
Yeah, I talked with Ben Cohen about that in very much detail, because we have different definitions of what that is. So he's very much into that lengthening cycle and diminishing returns, I think. I always thought that is like the time model, the logarithmic model, that nice curve that's also sometimes used as the demand part versus the stock to flow as the supply part. But it's much lower than. But what I learned from that interview was that lengthening cycles and diminishing returns, you look at the top, the market tops. You look only at the market tops, where I look at averages, right? I look at the regression line, the averages. So he looks at market tops. So lengthening cycles means that the top is later every cycle. And right now it seems like if this was the top, the 69, it was at the same location as 2017. So it's not really lengthening. If the top is not in and will be here in this year, for example, in the summer, then we have, according to that definition, lengthening cycles.
Yeah.
And diminishing returns, same thing. So the tops tend to be relatively lower each cycle. So 2017 was lower, had a lower top than 2013, and now if 69 was the top, we had a lower top this time around. Of course, if we go higher,
this is my theory of contracting the CAGR.
Yeah. But I do not. Well, I should say that differently. I'm not that much interested in the tops and the bottoms, because those are one-day events. I can't buy or sell large positions in a day. So I'm much more focused on the average plateau, where we like the 50,000 of last year. You could have bought and sold a lot of money on those levels. So where the exact top is and where the exact bottom is, actually, I don't really care. And but I should say, the general thought that the lengthening cycle guys and diminishing return guys have is that the volatility, as the market grows, the market cap grows, the volatility goes down. I don't think that necessarily is the case with Bitcoin.
Why do you think that? Yeah, explain.
Yeah, because like I said before, I think volatility is suppressed in most markets by the quantitative easing, by the central banks, by...
Okay, and this is outside money.
Yeah, and defaults are not permitted. So a company will be saved by QE money and not letting not being allowed to default. So where does the volatility go? And Bitcoin is one of the last places on earth where volatility can exist. And I think if you look at option markets, they for sure do not foresee lower volatility in the next 12 months. So I guess the market the Bitcoin price will behave, the distribution of Bitcoin prices will be non-normal and very power law distribution like with large volatility and actually um, without a clear standard deviation or variance. So that that's a special part of math or statistics, if you will, which also ties nicely into the exponential growth theories. That it's a non-normal distributed returns market, and volatility plays a really large role. And I guess the volatility will stay. And but maybe I'm wrong. So it's very interesting and important to keep watching the implied volatilities from the option markets, because that's where volatility is traded directly, and those markets do not indicate any decrease of volatility in the next 12 months.
Talking to a friend of mine earlier last week, and can't say who it is, but he was saying that the rumor is that China, not only did they ban Bitcoin mining and all, they're going to start to potentially go after individuals that they can see still have it, right? So if you have it on an exchange, or they're aware that you have it, so they might start essentially locking people up. I mean, this is a rumor that's starting to circulate over there. I don't know the validity of that, but the person who said it to me is very credible. But what do you think of that? And then so basically going back to the volatility and going back to tops and bottoms and the average and all this kind of stuff and the price moving forward, nobody knows the future, right? But if you look at what's happening with the Federal Reserve and that potential news coming out as they start to, because they're not going to do, if they're really trying to do this to screw up Bitcoin at China, because they want to control their own money supply and they think that Bitcoin is a threat potentially. I don't know, right? If that's what they're thinking, who knows? But if that's the case, the time to hit them with that news would be as the Fed raises rates. So, because that's going to make all assets, kind of to your point you said earlier, asset prices will come down. And then if they hit us with that news, it's going to just exacerbate that. It's going to go even faster. What do you think of that?
Yeah, it would be best to ask a Chinese investor who is in China, of course, and who experiences. But what I hear from Chinese investors is that this is indeed true, and has been this ban of mining has been followed up by a ban of trading, actually, not owning Bitcoin but trading. So all the exchanges and had to sell close their accounts basically by December 31st. And that's why we have seen this large decline from 69 to the 40,000 right now. Is mainly
pushing sell.
I guess, and there's a lot of analysis. I retweeted some of that. I think it was Glassnode analysis that shows that and we know that. I mean, if you're all the selling last 2 months was done in Chinese working hours.
So that's what it is. Yeah,
that's what it is. So that's where the selling came from, and there is you can see exchange balances, the number of Bitcoins on exchanges, and all the Chinese exchanges are close to zero right now. But we have seen them decline the balances over the last 2 months.
That's really interesting as it relates to stock to flow, right? Because it's about supply and stuff, right? So you're seeing this unusual amount, or maybe not unusual, but you're seeing a large amount of supply coming in unexpectedly based off of what the model might have predicted, right? So the supply kind of screws up the
no. The supply of the stock to flow ratio is the supply in the market from the miners. Yeah, so it doesn't matter if it's in custodian or on exchange,
but it is supply and demand overall. And if more supply is coming in from existing holders, in addition to that, it kind of screws up. How do I explain this? So what is it, 90 coins a day right now versus 180 before March 2020, right? So 90, but you're increasing it if you have more sellers, right?
Yeah. So it's demand and supply on exchanges or in the market, which is of course directly impacts the price, which causes the price to be what it is, but it's not relevant in the context of stock to flow.
Okay,
because that is only the supply is only the number of coins that are mined every month in this case.
Okay. But it is relevant relative to the price because it's all
Sure.
based on supply and demand. Okay.
Yeah. And then if everybody's selling, then the price goes
It's
down. Of
going
course.
down. A lot of people are like, why? But my friends are like, got people in the Bitcoin. They're like, why is the price going down? I'm like, there's more sellers than buyers. Sorry to tell you.
Actually, it's good news, right? Because the December 31st is over, is behind us. So the exchanges are empty, are done. Trading is not. Yeah, well.
So that's not coming. That already happened. So he might have misinterpreted that. That's interesting.
Right.
Okay.
So now we're back to inflation, and what's the Fed going to do with the interest rates?
That's, I think, the big catalyst at the moment. That's
Sure.
probably, and then we won't shake that out, I think, until Q2. I really believe it's going to take until Q2 for this to whole shake out. And so who knows where we go from here to there.
Yeah. So very, very interesting. And if that, and of course, all the expectations about what the Fed is going to do are already priced in the market, are in the interest rate right now.
Mm-hmm.
So the move from 1.5 to 1.8%, that's because investors think the Fed will raise interest rates, because that's sort of what they said indirectly. But if they don't follow through with action, that will
because the
surprise
market's
the
selling
market.
too fast, right?
Yeah,
they have
exactly.
to pull back. Yeah, the market's, it's like the tail wagging the dog. The market's 2018 is when I realized there's something wrong. 2015, I sold my company, started to invest a lot of my money in the market, and then they and by the way, they were raising rates in 2015. People always say, "Oh, in 2018 they raised rates and they can't do it because they couldn't do it." I'm like, nope, they did it for 3 years, guys. They did this for 3. I know because I had a lot of money sitting in the market, and I was like, "Oh, this is cool. We're actually going to see an interest rate at some point." Right? Yeah, you get lucky and you get all this money, and you're like, I forced all into equities. This is crazy, there's no risk-free instrument anymore. You're losing money to inflation. It was just an incredible thing. But then you start to see the interest rates start going up quarter point. And then that last one in December of 2018, I've never seen this before. I wasn't really, maybe I wasn't paying attention as a younger person, but when the Fed goes on 60 Minutes to talk down the market, I was like, something's not right about this. This is crazy. When Jay Powell was on 60 Minutes, I remember that. And I was like, that's crazy. Like, the market's telling him what to do, huh?
Yeah. Well, yeah. So you never know, right? It's I think it's Fed policy to not surprise the market, because that's bad.
Well, what was the surprise? He was raising rates for 3 years. There's no surprise. They just decided one day, we don't like it anymore. So this is it. That last quarter point, we didn't like, and it wasn't like they sold off to get back to where they were a few months ago. They just it dropped like 20-something% very quickly,
Yeah. However, I have to say, because I think all the interest rate decisions and the QE decisions right now are sort of influenced by what has been done the last 2 years. After March 2020 COVID response, the quantitative easing, and the interest rate was 1.9 something, a little under 2% just before COVID started to appear. So
every time they get to that 2%, it sells off. In that case, there was an exogenous event, but yeah,
we're about at the same level of 10-year US interest rates as we were before COVID. So Q1 2020, a little before that, I guess, end of 2019. So, yeah.
And the repo markets were showing signs even before COVID that things weren't right.
Exactly. So, yeah, it would surprise me if they, of course, they could go on to 250, maybe to 3%, but higher than that, nah.
It's not possible.
Nah.
Yeah. Well, before we jump, let's go into 22 and beyond. For me, it's the Fed. So what do you think the biggest risk is moving forward? For me, it's just interest rates, right? But what do you believe the biggest risk, or what are you most worried about maybe for 2022 and beyond for short-term price action?
Oh yeah. I don't know. Well, I guess the most important events are the ones you don't see. So if you would have asked me this question end of 2019, I would have never foreseen COVID and the
unforeseen events,
enormous impact that had on QE in the markets and Bitcoin. So I guess we're going to have another unknown, call it a black swan event, somewhere this year that will,
you think it'll be this year? You think so?
Yeah, I guess so. Yeah.
It's like the market's looking for that. They just want to pull back. It's like it's getting a little too rich for everybody's blood.
Well, one of the things I'm following, but don't read too much in that, but I find it interesting. It's on my radar. COVID was a scenario, of course, that was been written about before 2020, and there were in that particular. So it feels a bit like you could see it as a drill, basically, and there were more scenarios written in those documents. And one of the scenarios is a computer virus. So we had the real virus and all the responses like lockdowns, etc.
Yeah.
But a computer virus. And think about the small incidents that we've seen already in the oil pipes in America that were hacked, and then ransomware, and there's a Bitcoin component there as well. We've seen some of those incidents in Europe as well. They were less frequently published. But I see there was a big drill like a month ago, 2 months ago in Israel with 10 countries. US, of course, Israel, Netherlands, well, the usual suspects, where they sort of planned the whole event. And we might, it might be a little bit of a tinfoil hat thing, but I'm watching those stories closely, and so that's one thing. And another thing is, but that's very macro, of course. We talked about Kazakhstan, and we see some troop building up of troops around the Russian European borders as well, which is small, doesn't get much media attention. But in alternative news / Twitter, it's very interesting to follow what happens in those countries. And for example, Kazakhstan is as large as Europe. It's a very big country. It has, I think, 80% of all the oil and commodities of Russia. So it's a very important, strategically important area for, well, at least Russia. But so let's see what happens there. And that's to Russian borders where there is movement. And I think we have to, from a geopolitical point of view, have to watch that as well. Yeah, and of course the other big topic, but that relates to the Fed is inflation. What will inflation do?
Which we haven't really talked about, but yeah, go ahead.
I mean, we've seen
it's a big topic.
It's a big topic. We've seen asset inflation, especially if you look beyond the CPI into the real stuff like education and healthcare and assets like real estate.
Healthcare went up 30% for most people in the United States from last year to this year.
I can tell you electricity prices in Europe have gone 3x. So an average family in Europe pays like, what is it, 200 euros a month for electricity? 600 now.
Yeah, and the only way people are able to justify it, there's no justification for it, but the only way they're able to swallow it, I guess, is that as a line item, like an actual line item. If let's say your electric bill was like $60, now it's $150 or something like that. They could absorb it, even though the percentage is off the chart, be relative to everything else they have, right? But it's not sustainable to keep doing that.
It's not sustainable, and I think we will see that spill over from asset inflation to normal inflation, and we're seeing that at the moment, of course, which is why the Fed reacts. But if history is any guide, then the Fed will not be able to contain that.
This is like the tweet that Dorsey put out, right? Jack Dorsey.
Oh, I missed that.
He called it hyperinflation or something like that. Everybody freaked out because it's not technically hyperinflation, but
Yeah, no, hyperinflation, because what they did to the money supply cannot be undone. And they haven't thought about it well enough, so it cannot.
You think they haven't thought of it, or they just didn't think they had an alternative?
That's it. They had to do something, because doing nothing is not an option.
Because you're allowing this market to crash, and they don't want to let anything crash anymore.
Yeah, you can imagine how those board meetings go. Like most people know that doing nothing is probably the best option, but that cannot be allowed. You cannot do nothing, and then somebody becomes angry, and we do something, and the money, blah blah blah, and so which I think was a stupid thing. They should have left Lehman and all the other investment banks go bust.
See, my buddy tells me that there would be no money coming out of the ATM machine the next day. Do you believe that, or you guess not, right?
Do I believe? Yeah, I do believe. I can tell you some other insights. We all thought that would happen, because that would those banks were basically broke. And Greg Foss, of course, talks about credit default spreads. That's why a lot of people saw this coming in 2007 and 2008. Like The Big Short is the big. If you look at The Big Short, that was me at the time. We were, and everybody in the banking was like that. Everybody saw it coming, and me and my friends actually had a lot of cash stashed for the event that ATMs were not working and banks would go bust. Even had food. We were sort of preppers to survive the next 6 months. I even had water, rice, all this. It was crazy time actually, and then it didn't happen. But because the banks were saved with all the money.
So many people got that trade wrong because nobody anticipated the Fed doing what the Fed did. And then I think really a lot of people last year got it wrong too. Not a lot of people, but most people I think know the playbook now. But a lot of people still don't believe that playbook will continue to keep running as it has. And they're kind of trying to front run when it doesn't work,
Well, it is very important as a Bitcoiner to think about this if you're into that kind of geopolitical stuff. But one of the reasons that why governments and countries can engage, can do this saving of banks in 2008 or saving the economy into after COVID is because they can print money. Mm-hmm. It's because they can debase our money, because they can create inflation and let us all pay for that. So governments can do their warfare and welfare, if you will, because of their ability to print money. What if they would not have that ability? We would have less warfare and less big scale government programs. And maybe that's a political
forcible
thing.
Austerity.
Yeah. What do you think? That's a good thing or a bad thing? I think
I have some liberal friends that think it's a bad thing. So they're like, no, we need to print more money because we need all these types of services and et cetera, et cetera. And I'm like, but you don't realize the consequences. There's unintended consequences.
Well, actually, that's the big underlying debate right now between economists and Bitcoiners on the one hand, libertarians and the Austrian economists, and the normal or Keynesian economists on the other side, and especially the governments, of course, and the central banks on the other side. For example, the ECB, the European Central Bank, doesn't view Bitcoin as money because their entire worldview is based on money has to be printable, has to be controllable, has to be. We have to be able to make more of it, otherwise the economy and the whole world is not functioning. That's their basic belief.
Yeah, this is the Greg Foss argument. I'm not Greg Foss. Jeff Booth, right? He's like they believe they need to have inflation, but really everything is actually deflating. They're buying the growth by printing more money. There is no growth.
Yeah, exactly. But of course the world worked well before 1971 as well, where we had all the currencies linked to gold. So, but of course they removed that link because otherwise they had to stop the Vietnam War, it's a very difficult thing for governments to not have that tool of money printing because they'll be much smaller as a government and in their ambition, and it would be much more markets that decide who goes busts, and so I think it's a very fundamental discussion underlying that we're seeing played out in real life, which is the stuff that movies will be made of, like The Big Short,
they'll call it
a couple of years from now. But it's very, very interesting to realize that as we're living it.
I put a tweet out there. I said, "Who's going to play Michael Saylor in The Big Long?"
Yeah, exactly.
Right. Before we hop, just want to say, you said 2017 you joined Twitter. And I think I was looking at an old interview. I was doing research and watching a bunch of interviews, and I saw an interview like 2 years ago. You had like 70,000 followers. Earlier this year, I remember when you passed a million. I think you were on Pomp Show talking about it. That was like a few months ago. You're 1.7 million. Like this thing is like a runaway train. What's going on here?
Yeah. I sort of 10x every year. So
that's incredible.
From 1,000 to 10,000 in 2019, and to 100,000 in 2020, and then to 1 million plus right now. So the growth rate, actually, talking about exponential growth, was about 20% a month. which has not changed, which was very, so it wasn't, I guess it wasn't one thing, but just a gradual growth of 20% a month.
I told you earlier, I built like a video sharing embed website. So that made sense why it grew rapidly. You take a video, you watch it, you click it, you copy it, you paste it, someone sees it, they click it. It's got a viral coefficient, right? Greater than 1, and it just continues to grow. What's your viral coefficient? That stock to flow is just that viral verbally? Like, it's amazing.
Yeah, well, it amazed me as well. So I don't know. I guess people like price predictions.
Yeah, pricing. I think Jimmy Song told me, he's like, if you talk about price, you'll get more views. I don't usually do that actually, but
and I know a lot of developers are mad about that. Maybe mad about me for only doing price models and getting all the attention, and a lot of other folks as well. Because of course,
like Will Clemente came out of nowhere. Will just got like 500,000 followers in 6 months. It was crazy.
Same thing, yeah. But of course, the development of the code is much more important, and building businesses around Bitcoin is much more important. But in the end, I think the incentive of making money is the strongest incentive there is. And so it's not necessarily a bad thing that people are interested in making money and price predictions and any kind of information on chain from Will Clemente and stock to flow, more fundamental from me. And so I guess the incentive is not a bad incentive from a market's point of view.
When you're talking to people, I learned this a long time ago. I forget, it was like How to Win Friends and Influence People or some book like that. They're always thinking about themselves when you're talking about anything, right? I don't care what it is in life. They're just saying, how does that relate to me? Why do I care, right? Yeah. And with price, they care. They own the Bitcoin. They want to know where they think the price is going, right? So you speak to their incentives, you speak to their concerns and their thoughts, I guess.
Yeah, maybe one more thing, because that's one part of the story. The other part of the story is that I guess people like me, institutional investors, quant investors, professional investors, they feel the need for something mathematical, some compass, or if you go, how do you call it,
blueprint,
some guidance, and also the notion of arbitrage between fiat and Bitcoin world, which we talked about, between risk and return that we talked about, between derivatives and spot markets that we talked about. I think they like with Greg Foss. I never heard of him, but then he had 1 or 2 tweets. I could tell from those 1 or 2
11th
tweets.
grade math.
No, it was not that. But
no, I knew it's a famous meme.
I knew that he knew his stuff. He knows his stuff. He has been in the market for years and years. Otherwise, you could not have said. And I recognize that in 1 or 2 tweets. I'm quite sure that other people recognize that with me. So, and they actually say that out loud as well, especially in the private conversations. Like, even if the model breaks in the next 1 or 2 years, it doesn't matter, because I like your perspectives. I can tell, I can hear your experience, and I like to know what you think about, like we talk about the Fed or whatever.
Yeah, I was going to ask you. That was my next question, actually, to wrap it up. It's like, if the model breaks, what's the plan B? No pun intended. Like, is it the plan C? There's everybody jokes about that. When's plan C, right? No, but if it breaks, though, is it just the intellectual capacity of how you describe the markets and think about the market? Is that where you'll move forward? And it's not necessarily just you're always about this particular model. It's just the worldview and the way you kind of think about Bitcoin and markets in general.
Normally I block people that ask. No.
Don't block me.
No, for sure. No. Yeah. How do I say that? I guess Will Clemente tweeted about this as well. He's the on-chain guy now, but he does a lot more on on-chain only. So I'm the stock to flow guy.
Yeah. You were on his show with Willie recently, right?
Yeah, Will and Willie.
I was talking to him the other day about you.
Yeah. That was fun with Will and Willie. So it was just so
chat. Funny. They both have the name William.
Yeah. But I guess I'm the stock to flow guy. Everybody's plan B is stock to flow, but I don't see myself as only the stock to flow guy. I'm an investor.
It's kind of how you rise to prominence, but it's not everything.
Yeah. So the on-chain stuff, I'm the only one not the only one, but who's doing all the crunching himself. I see a lot of patterns. Lots of it are not published yet. There's a lot of arbitrage, which I think is very important, and lots of people are looking at the cash and carry and the covered call writing and stuff.
So you're going to add value in a variety of different ways, not just this particular model.
Yeah. That having said that, I could see myself going dark and delete the Twitter account when it hits, say, $100,000 to go to have all these interesting discussions that are the reason I am on Twitter on the first place, but then in a more private setting, because right now it's become too big in a way that there's too much noise, hence my blocking. There's too much stuff I am not interested in. And I know right now who are the interesting people to talk with. And so I'm building,
your network,
my network. And I probably...
Can you monetize this through a fund or something like that? Because you're not no longer with the fund you were doing, but like, could you do something in Bitcoin? I don't know, like some kind of a model. Is there anything there?
I've thought of that. Of course, you can monetize it bigly if you do a deal with exchanges and get part of the trading fees. That's how most people monetize, of course, their account.
I think Willy Woo does stuff like that, right?
Yeah. But no, I'm not doing that. I get, but and newsletters are a great source of income. I mean, there were. I did a poll once.
You don't even do that though, right?
No, I don't do that. But there were in a poll. That was like when I was below 1 million. There were 10,000 people that were easily putting $50 a month for a newsletter. But then it becomes work again, and I just
it's a job.
Well, exactly. It's a
commitments,
job,
right?
and I sort of think my view is I'm an investor. My money should earn my living and not my work, my hands. I try to do, that sounds weird, but I try to do as little as possible and
let your money work.
Let the money work. So the whole passive income thing is with the covered call writing and etc. That's where my, combined with on-chain, that's where the passion is. Can we do a fund? Yes, of course we can do a fund, and but that would be work again as well. Could we do? I talk to a lot of funds on almost on a daily basis because I find that interesting. And of course, there's always the question like, can we do referral and those are, and I do that sometimes, but I don't want to be the commercial guy. I want to be the independent guy, and I want to. I'm quite sure that the information that I lose because I will go commercially will cost me more than what it brings me, the inside information that I get now because I don't have any links. So if I will go commercial, and of course there are some things I've thought about, then it will be very small and very non-Twitter.
Plan B, thank you very much for coming on the show. Genuinely enjoyed your time with you today, and thank you for taking time out of your day to spend with me. Thank you, Preston, for making the introduction. Everybody, Plan B.
Thank you, Jay.